Welcome to the Financial Feast podcast. I'm Kevin,
And I'm Zach.
and today we have with us Chris from
Hi,
the Merriman Foundation. How you doing, Chris?
I'm good. How are you?
We are doing great. One question that we always have for every guest, because this is the Financial Feast podcast, we start with food first. So food's important, right? What is the best food you've ever eaten? That is a hard question, I know, but
Oh, best
usually
food I've
people
ever
have a good
eaten.
answer.
I'm gonna go with uh, homemade pizza in our, we do homemade pizza in a pizza oven. So that's probably my number one because you get to make it however you want. So yeah.
All right. I like that.
That's excellent. You can't really go wrong with a good pizza, so I definitely can appreciate that.
Yep.
So now I know you're from California. What kind of crust are you a fan of when it comes to your pizza?
Well, I do like a cornbread crust because it's got a little more crunch, but most of the dough that we do for our pizza oven is just a straight up really simple, flour and water, 65 or 70% water kind of dough mix,
Okay.
fermented over like 72 hours. So, yeah.
Oh, I like it. I like it.
Wow. That sounds good.
Does sound good.
Excellent. So, the reason why we brought Chris on here is Zach actually, why don't you go ahead, Zach, kind of tell him the process of getting Chris onto here and why
Yeah.
we thought he would be a great fit for our audience.
Yeah, for sure. So, essentially what we're going to do today is we're going to be really discussing and looking into in a little bit more detail a book that Chris wrote. I think you wrote it by yourself. I don't know. I know you did a lot of the heavy lifting, at least with it, if
Yeah,
not.
I had collaborators at the Merriman Foundation, but
Okay.
yeah, it's mostly my work.
Yeah. So it's called Two Funds for Life. You offer it for free through the Merriman Foundation, so anybody can go online and find a free PDF for it. They can also buy it and find it, I'm sure, at most libraries. But we're going to be kind of jumping into this because the reason that I think that this is such a helpful tool is a lot of people approach investing as this complicated, complex, overwhelming, a little bit intimidating process. And frankly, it can be that for sure, depending on how you're approaching it. But the cool thing about this book that you've done is you've been able to simplify the process of investing without taking away the rewards of investing. So I think a lot of people are viewing investing as the more complex it is, the better returns I'm going to get. And you've really approached investing as, well, it doesn't have to be super complex to get a great reward still. We can make it extremely simple with two simple funds, and you can get not only match the return that you're getting with these complex funds, but potentially even get greater returns than these complex funds. So I think what we're going to do here is just kind of have you explain maybe a little bit about why you started writing this book, kind of what got you to think about these two different funds, and then explain what the funds are that people would go. So we're going to be talking about the target date fund and then the small cap value specifically, and then we can go into a lot more detail off of that.
Sounds good. So, uh, I work with Paul at the Merriman Financial Education Foundation. It's a nonprofit that he started with his own money, and our only goal in life is to help people invest better. And there's the thing that attracted me to it is that there's no conflict of interest. It's just his money. He doesn't, support advertisers or anything. And he had something called the Ultimate Buy and Hold portfolio, which is built with 10 funds. And that attracted me just because it said it was the ultimate. And I thought, well, the ultimate, that's what we're all looking for, right? And after I started working with him, he had this opportunity to go and talk to Jack Bogle, who some of your listeners may know as the early champion of the index fund. He created an S&P 500 fund that still lives today. And so he's legendary for helping investors, both as an educator and a pioneer in the field. And Paul, who I work with, had this opportunity to visit with him, and I said, "You better take that before he dies because he's pretty old."
Yeah.
And so Paul did. He went out and he talked to Jack, and Jack wagged his finger at him and he said, "You can't do this to people. You can't ask people to invest in 10 funds, rebalance annually, figure that all out. It's just too complicated. You need to do something simpler." And so that launched Paul and me down a path of trying to figure out how we could provide the benefits of this massively diversified investing strategy with a small number of funds. And essentially, that led us to this idea of combining a target date fund with a small cap value fund. And then the question is how much and when and how do you do it? And would it be as good? And that leads to a whole bunch of research, and that's part of the reason I wrote the book. Was I had to do the research to convince myself that it was prudent advice. But the upshot is a lot of your listeners will probably be defaulted into a target date fund at their work as part of a 401k or something like that. And that is a simple and effective investing strategy just by itself. It's actually a wonderful solution, especially if they dollar cost average into it over a lifetime. In fact, somebody who saves 10% of their income into a target date fund over 40 years and then takes a 4% withdrawal that they increase with inflation every year in retirement, just that process will probably double their lifetime spending power in real dollars, which is amazing. Most people wouldn't think that saving 10% for 40 years would double your lifetime savings if you invested it prudently. But our question was, could you do better? And the answer is yes, you can, as long as you pick an asset that is it moves up and down at different times than the assets that are in the target date fund, and it has a higher expected return. And that led us to small cap value. And so the book really is about how do you do that? You know, do you put 10% in small cap value and 90% in the target date fund? That's a good strategy. Or do you put 20% in, or do you scale it down over time? So there's a whole bunch of different questions, and that's what the book aims to answer. But the gist of it is you can do everything that you could do with a very complex strategy with a very simple one in terms of historical performance. And of course, nobody knows what the future will bring, but most of us judge the future by the past. You know, the weather forecast outside is based that way, and I trust that every day. So I'm going to do roughly the same thing with my investing. I'm going to look for things that worked 99% of the time in the past and hope that that works again in the future.
That's excellent. That's excellent. I really do appreciate that method too. We were talking a little bit before we started here about just the simplicity of this whole thing really being what drew us to it, but also just the whole fact of the matter being that because it's so simple, does it work? And the fact that it can work and even work better than the target date funds is really just a very interesting thing. So I would definitely encourage you. We're gonna link the book PDF in our show notes here. So if you're listening, please go check that out because it is definitely worth a read. Some questions that we had for you, Chris. How would this strategy work in a 401k? Because a lot of people have a 401k through work, and most people don't really know what they're doing, but a lot of people just kind of leave it where it's at. And typically, as you said, it's in a target date fund. That's kind of the current thing that is happening with the 401k. So if you're trying to do the two funds for life strategy and you have a 401k, how would you go about kind of doing this strategy with the 401k? What would be your thoughts there?
Well, first of all, uh, I'd encourage people to trust the 401k, but you know, trust with verification is always good. There's a fiduciary responsibility of a 401k provider to provide prudent investing choices, and if they default you into something, that fiduciary responsibility is great. So it's very likely that the options in a 401k are going to be chosen with at least some eye towards keeping expenses low with good positive expected returns. But it's also likely to have a limited number of fund choices, and it may have some funds that aren't ideal for this strategy. The target date fund, there's a very high likelihood it's going to come from Vanguard, but it may come from Fidelity. As long as the costs are low, I think Vanguard's costs now are 0.08%, so very small. As long as the costs are low, the target date fund is probably going to be a good prudent choice for the core of this strategy. And you're going to want to be invested in one that has a target date, usually in the name of the fund, that's close to your retirement date or your expected retirement date. So they might default a 25-year-old into a fund that's 60 or 40 years from now because they're thinking 65 is a traditional retirement date. But if you're planning on retiring early and saving aggressively, you may want to choose a different target date. So that'd be the first thing. And then the second fund you're going to want to add to this is a small cap value fund. Well, if you have a low cost, small cap value fund in your 401k, that might be a good choice. And you may be able to just set it up so that 90% goes into the target date fund of what you're setting aside for retirement, and 10% goes into the small cap value fund, and just let it ride. You might be able to just put it on autopilot. And autopilot's fantastic for saving, because once you got it set up, it's almost like you don't even sacrifice the money. It's just doing its thing in the background, and that's great. But if you don't have a small cap value fund available in the 401k, you can implement the same strategy with a brokerage account where you're investing some in the small cap value fund, and the target date fund investment is in the 401k. I've tested that strategy looking backward with no rebalancing because I knew that might be the way people did it, and you can't really rebalance between these two things. And it worked pretty well. In the past, it worked great. And in fact, you can look in the book, I've got in one of the appendices a comparison of what happens if you rebalance or if you don't rebalance. And so I think that's probably how a lot of people would do it. If that doesn't sit with you and you really want to work with what you have in the 401k, and let's say you have a large cap value and a small cap blend in the 401k, and you wanted to put 10% in small cap value, well, you could put 5% in small cap blend and 5% in large cap value and kind of approximate it. It's not really the same. It's weaker sauce is the way I like to think of it. But it's still probably better than nothing in the long run. It would still help.
So I'm going to get I'm going to jump a little farther back just so we can make sure that any listeners who are maybe a little confused that hey, they're talking about a target date fund, they're talking about a small cap value, I'm not fully sure what that means. So just for explanation point, right, when we're talking about a target date fund, we're picking a date that you're expecting to retire, so run out to 65. That date is going to then balance itself out. And when we're talking about balancing, that's just reallocating how much stocks to bonds essentially that you have, right? And most, if my recollection is correct, I think most target date funds are into a large cap growth or a value. Am I correct with that?
Most target date funds invest in a cap weighted total market,
Okay.
which has almost exactly the same return as large cap blend. If you look at a US total market fund and an S&P 500 fund, they'll look almost the same in terms of returns going back. Yeah.
Okay. So then when we're talking about the simplicity, that's the simplicity of that target date fund. But the real interesting part about this two funds for life is then that inclusion of the small cap value, right? Because that's what kind of gives you that boost of power that most people aren't getting. So can you get into maybe just explain a little bit about what specifically a small cap value is as opposed to a large cap when we're talking about size of a company valuation there? And then can you explain why specifically that gives that boost? Why is that beneficial and people need to actually look into that?
I'll be glad to do that, but I'm tempted first to kind of finish out your thought on what the target date fund is and why it does this thing where it starts out with a lot in equity and then ramps down to more bonds and less equity. Why
Yeah, for
why does
sure.
it do why does it do that? And the answer is when you're young, typically you don't have a lot to lose in terms of money. You don't have a big, most of us didn't start out with $1 million. Most of us start out with very little and then are trying to build it up. And we have a lot of time. We have a lot of time to let our work and our compounding and our savings help us out. So when we're young, we can take a lot of risk. And if we lose a high percentage of our portfolio, that matters far less than the fact that we're going to now buy some stuff cheap when we do our next contribution. So when the market's down for a young person, it's actually kind of good news, because it means that the next purchase you make is going to buy more stock or whatever it is you're investing in. When you get older, you don't have as much time for the compounding and the saving and the working and everything else. And so if you're on the eve of your retirement and you lose half of your nest egg, that's likely catastrophic for most people. And so what the target date fund is, it increases the amount of bonds that are in the target date fund as you get near to that retirement date. And what that does is it makes the portfolio less volatile. It doesn't go up and down as much. It gives you greater confidence that as you're going into retirement, you know how much you're going to have to be drawing on to set up a safe withdrawal rate or, a reasonable living kind of plan. So the target date fund is very prudent in that respect, and it lines up nicely with the way most people are going to feel about the risks they want to take at these different ages. Okay, so now to your question, Zach, why does small cap value help, and why did we pick that? Well, people, academics, specifically some Nobel laureate academics, Fama and French, way back in the 70s, did research to look at how different parts of the stock market performed. And they chose to divide it up by the small part of the market versus the large part of the market. So these are companies that are smaller versus companies that are bigger. And they also looked at companies that were, I'll call it fashionable, the expensive ones, the high flyers, those we call them growth, versus the out of favor ones that tend to sell for a lower price to earnings multiple or cheaper compared to the value of the underlying assets of the company. And those are called value. And what they found was that the value part of the market, the out of favor part of the market that nobody was super excited about, when you bought into a group of those stocks, they actually historically gave a higher return than buying into the really, really expensive ones, because the expensive ones often over time fall out of favor. And the expensive ones, you're paying more for the underlying assets, so they have farther to fall. So that's the value versus growth. And then the small versus large, over time, this difference has kind of narrowed. It's become less significant. But in general, the smaller companies had a little bit more growth potential. But when you combine these two things together, when you look at the small companies and you look at the small value companies, they had the highest historic growth of all. And part of the reason for that is the small growth companies perform so horribly bad. So that's why when you look at small versus large, it's not as big a difference. But when you look at small value, it's a bigger difference, because the small growth companies just do so poorly. So if you take these small value companies, they have a higher expected return, because historically, you have to go, I think 99% of the 20-year periods that have been analyzed, 99% plus, small cap value outperforms the market at large. So it's not a 0% chance that it won't underperform, but it's a very small percent chance. And even when it lags, it tends to only lag by a little bit. The part that makes it even extra interesting, though, is that the returns for this part of the market, these smaller out of favor companies, tend to come at different points in time than the returns for the overall market. So that means you get this kind of diversification when you combine it with something like a target date fund, because it's zigging and zagging at slightly different times. So you get not only a little bit of an increase in return, but you don't pay a penalty in a great increase in risk. There's a little bit more risk, but not nearly as much as you might expect for the amount of increased return that it has, at least historically. Yeah.
So you had mentioned that it might lag the market a little bit, but historically it will outpace the market, correct? With the small value, cap value ones.
Yeah, small cap value, and this is one of the reasons I think a lot of people will be well served by putting a portion of their portfolio into it, not going whole hog into it, right?
Sure.
Historically, you can look back and you go, what's the highest returning segment of the market? Small cap value. Well, why don't we invest 100% in small cap value? First of all, it's a little bit more volatile, but secondly, it can underperform for 5 years, 10 years, 15 years, almost 0% time, 20 years. So the worst thing you can do is invest in something you think will have a higher return and then panic sell and get out of it while it's down to trade into something that's probably more expensive and then never get the premium that you were looking for. So it does have this attribute that since the returns come at different times, sometimes you're going to lag, and that's important for people to know if they're going to invest in any strategy that expects a different return. If you want a different return, you're going to have to ride a different path.
So I think that pretty naturally leads us into a question that a lot of people probably are curious about, right? Is what percentage of my portfolio should I have? And then what does that look like as far as rebalancing through my age? I know that Paul has talked about a 1.5 percentage of your age rule as he's looking at the valuation of how much he has in his, and he recommends for people especially. So if our audience is, so let's say somebody's listening, they're 25, it would be different than a 40-year-old listening. So how would you kind of help them work through what's a good quality number to have at their age, as far as that small cap value to the target date fund in their funds?
It's a great question, and it's a very personal question. So in the book, I recommend three strategies that I use kind of as teaching examples, and we walk those through and explain how much more volatility and how much more return you would get. In those three examples, one of them is you do this 10% of your retirement savings into small cap value and 90% into the target date fund, and you never rebalance. That's the simplest. The second one, you take 1.5 times your years to retirement. So we did that because if you do the age thing, it assumes that you're going to retire around 65, 66, and not everybody's going to do that. So let's say you're 25 and you are going to retire at age 65. Well, that means it's 40 years is your years to retirement. So 1.5 times 40 years would be 60. So you would put 60% into small cap value and the rest into the target date fund. And then what happens is as you approach retirement, that goes down to zero. Because when you get to 0 years to retirement, 0 times 1.5 is zero, and you're out. You're just 100% in the target date fund. So that's the second, what we call moderate strategy. And then the aggressive strategy is you take 2.5 times your years to retirement and you add 20% to it. And what that means is that when you're a young person, you're 100% in the target date, or I'm sorry, in small cap value. And then somewhere around age 40, you start ramping down, but you leave this floor of 20% in the small cap value, even into retirement. And the reason we did those is that we know people are going to play with this and they're going to figure out what they think works for themselves and they're going to do something different. We wanted to give some illustrative examples. And in Appendix 1, there's a whole bunch of examples, even more that I just talked about. You can look at what happens if you do 30% into the target date fund and don't rebalance. So the answers are in the book, but the upshot is that you've got a shot at between 15% and 100% more money, depending on which of these strategies you use in retirement. It can be quite substantial, and you pay for it. And what do I mean you pay for it? It's not that you contribute more, but you have to pay for it with good behavior, because as you take more risk to get more return, you're going to have to tolerate a bumpier ride. And that bumpier ride that's part of the reason I wrote the book, was to try and do all of the back testing and all of the characterization of how much bumpier that ride was historically, so that you can see what you're going to have to tolerate. And I'm going to come back to the very first thing I said. This is really individual and personal. And the two things that I think really matter the most to an individual as they make this choice are, number one, how much of this up and down volatility are you going to tolerate, or underperformance, years, are you going to tolerate before you give up on a strategy? Because the last thing you want to do is get into a strategy that you bail on partway through. That's really costly. So that's the number one thing. And then the number two thing is, how much do you know and understand about the strategy that is going to keep you committed to it? So that's, again, why did I write the book? It's kind of an owner's manual, so that as you're running into questions, as you're partway down the path, as you're doing what ifs, and kind of things are popping up. I can't be your advisor, but hopefully the book will be their advisor and help them stay committed to a strategy that's going to help them out.
It's fantastic.
Yeah, that is great. I've heard some arguments too, and I was wondering what your thoughts are on this, about using maybe an international small cap value fund, or just an international fund in general. A lot of people, like right now, it's kind of a buzz for the international because, you don't want to have all your money in one spot. S&P 500 is so big. What make internationals generally considered the more risky, aggressive growth or aggressive portfolio. But what would your thoughts be on that?
I love that idea. And in fact, there's a whole chapter in the book on intermediates that include three funds instead of two. So you just take the allocation to small cap value and you split it between US and international. And as long as you have access to an international small cap value fund, you can do that. The benefits of diversifying internationally are that you protect yourself against one single country risk, which, you know, you like to believe that your country is never going to run into catastrophic problems, and the U.S. has had a really good run. We've had a fantastic last century, and there are a lot of advantages to investing in the U.S. A lot of people from around the world invest in the U.S. But those countries that had catastrophic failures probably never saw them coming too. So when you invest internationally, you do take some risk, but you also protect yourself from some risk. And the academics would usually say just do a cap weighted worldwide allocation, which is close to what's in the target date fund. They tend to tilt a little bit to the US, but they're pretty close. They're global. So yeah, I have absolutely nothing against that. I think it comes down again to how much can an investor stomach, and that's a personal thing. Some people are more comfortable with outside the U.S. investments. Some people are less comfortable.
The stock market is obviously something that, to your point, is always changing. And obviously we have a lot of history, since it goes back 90 plus years, to kind of work through on our end on how the trends are typically going. When we're looking at the future, though, that's clearly something that's difficult to tell. We don't know necessarily what's gonna happen. So how likely is it that the future is going to be like the past for us? Obviously, as the market's changing and the world seems to always be constantly changing. This fund, yes, it's worked in the past. Are we pretty confident that it's going to continue to work in the future?
I'm fairly confident because I've tested every single starting month from 1928 up to the present with these strategies, and they worked well historically, especially for people who would have stayed with it for 20 plus years. So I'm pretty confident. But we get weather patterns that are crazy and different sometimes, right? And
Yeah.
you get market patterns. Last year's market pattern was bizarre. It's really strange to have safe assets like bonds and stocks go south all at the same time.
Yeah.
Last year was just a crazy year. So it was different. But um, if somebody had told you 2 years ago that that was going to happen, I'm not sure what you would have done with it, right? Even with a perfect crystal ball, the best thing to do is probably still to write it out, just to ignore it, look at it as a speed bump along the way. And I think it's really important that investors understand the media is going to try and tell you every single day that this time it's different. They're going to try and freak you out. They're going to try and engage you with alarmist kind of headlines because that's what sells their media. That's what holds your attention. That's what keeps you engaged. And the best investors are the ones who are calmer and more Zen-like and able to say, you know what, 1928 was pretty bad. You know what, that the flash crash was pretty bad. 2008 was pretty bad. Maybe this is as bad, I don't know. But in all of those, writing it out was still a better thing to do than to freak out and panic sell.
Yeah.
Yeah, absolutely. The another question that might be asked here is how resilient is this approach, the two funds for life? Is it to surprises? So you kind of just touched on this a little bit with writing it out is always the better strategy in anything when it comes to investing. And I do agree with that for sure. But as opposed to another strategy or two out there, there's so many out there, obviously, but what is the resiliency, I guess, for these people? And I know that this once again depends on their risk factor and also, personally, right, where they're at and kind of how they almost psychologically respond to everything. And it gets deeper than that. But on a top level, like how are how is the two funds for life kind of resilient to surprises in the market?
I think it's pretty resilient, and the number that I tend to focus on when I think about resilience to sequence of returns risk is the safe withdrawal rate. And one of the things that was a really pleasant surprise to me as I ran all the back tests that we did for the book is that in the retirement years, when you're taking money out, I calculated what the safe withdrawal rate was for 30 years and 40 years. And adding some small cap value to the target date fund increases the safe withdrawal rate. So it's counterintuitive. You would say, should a retiree, somebody at the most conservative time of their life when they have no income, should they be increasing the allocation they have to this risky asset, small cap value? It's counterintuitive that you would do that, but by doing that, you actually improve the chances of the portfolio surviving a 4% withdrawal rate all the way to the end, or a 4.5% withdrawal rate all the way to the end. And so for a retiree, it definitely is a good thing to think about. And Bengen, who was the creator and the initial researcher who did the work behind the 4% rule, I heard him interviewed recently, and he said that he has revised the 4% rule upward for people who add a tilt to small cap value in retirement, because it's that zigging and zagging at different times, right? Since the returns come at different times, it gives you the ability to draw on the asset that's been doing well recently instead of having to sell the one that's depressed at the moment to fund your lifestyle.
Another question that I kind of got when I was reading through the book, just in my own thinking, right, is this, and we can maybe after you, I don't know, maybe I should ask a different question before. We haven't really necessarily gotten into the return in as far as number wise. You go into a lot of detail in the book, and you compare a lot of different information. There's a lot of different charts, and when we're looking at return, as far as the two funds for life in comparison to a normal allocation of whatever 60-40 that someone might have, depending on their lifestyle, life age or risk factor, whatever, we're saying just in general, and maybe we don't have to go into too much detail, but we're saying in general, this is going to return more than the average person who's in blank whatever. I don't know whatever they're doing. If they go to this is going to return more. Can you maybe break up those numbers on what we mean by this is going to return more on an average for a person, right? Like when they're saying, is this going to return 0.01% more on average? Is it going to return 3% more on average? What would that look like, you think, for the average person? I know that's a hard question to answer because there's so many variables.
Yeah, there are a lot of variables. It depends on what their cash flow is and everything else. But across this lifetime scenario that I ran, the Vanguard Target Date Fund across the entire lifetime had a CAGR of 9.8%. That's nominal. The 90-10 split had a CAGR is compound annual growth rate. So compound annual growth rate of 10.3%. So that was worth a 0.5%. If you were to do an 80-20, it goes up to 10.8. So there's another 0.5%. Let's see. If you do the 1.5 times years to retirement, it was about the same as the 90-10 at 10.3%. These are all in appendix 1 of my book, actually. So, and if you did that really aggressive 2.5 times years to retirement plus 20%, it went up to 11.4%. Was, and as a lifetime CAGR, a 0.5% doesn't sound like a lot,
Yeah.
but I also have it in here in millions of dollars, and it's huge. It's just huge. A 0.5% across a lifetime is a really big deal, because some of your listeners may know about the rule of 72, right? But if you take 72 divided by the interest rate difference, so let's say it's 1%, that's how long it takes in years to double. So 72 divided by 1%, it'll double in 72 years. So if you can get 1% out of these, you'll have twice as much over a 70-year investing lifetime for the dollars that you invested at the beginning. Those 0.5% are really, really important.
Yeah, and I think the other side of that, right, where Paul is so in all of the things that he puts out on the website and in the podcast that he's on, he really emphasizes, and I know you emphasize this in the book too, getting into low cost funds also. So not only are you getting a higher percentage on the return, but then you're also saving percentage, right, on the load that you're having and the management fees. So we're going more to the passive. And we've talked about this already in a previous podcast where we're very pro low cost index funds, because in these index funds that are these passive index funds, you're getting these low management fees that you're not paying somebody extra when they're not actually overperforming. I forget the exact stats, Kevin. I don't know if you remember it, but it was like 91% of people are paying extra on these mutual funds that are actively managed. And within like 3 years or something, they're already underperforming these index funds. So when you're getting these low costs, you're not paying as much, and then you're getting a percentage more, a 0.5% more, to your point, over this 35-40 years of investing. It doesn't seem like a lot when you're getting 0.5%, right? But it can change depending on how much you're putting in there. Paul wrote another book, right? We're talking millions. I mean, it could be millions and millions of dollars.
Yeah, I've also done the analysis of what it costs you across a lifetime to pay 1% to somebody to manage your money. That's a pretty typical fee, 1%. And if you pay 1% across a lifetime to somebody to manage your money, at the end of it all, over an entire investor's lifetime, there's a good chance that the manager has as much money as the investor. So, and that's not to say there's not value in that for some people. Some people will not behave well unless they have somebody holding their hand. Or I've had people come to me and say, I understand that, you do financial education and I've got to figure out what I'm supposed to do with my money here. I'd love your help. And I'll start to engage and they go, I don't want to learn any of that. Well, if you don't want to learn any of that, you're probably better off just paying somebody to do it for you, because you need to learn, you need to know, you need to understand. And so that 1% can be well spent, but it can add up to a lot. Yeah.
So I wanted to do a quick follow-up, Kevin. I know you got
Oh
a
no, you're good.
question. I'm sure I don't want to jump over you, but
No, you're good.
this was the original question that I wanted to ask. I thought it would be helpful to maybe have a little bit of background information. Um, so since this is such a beneficial approach, and since this is such an easy approach, the question that I had when I was reading your book really is, well, why don't everybody who's managing money approach their investing this way? Why are people not? This seems like it's like such a revolutionary thought on like, whoa, we can do this and get more money. Like, why isn't everybody doing this, right?
Well, I think that if you're a manager, I can think of several reasons you wouldn't use this approach. And some of them are totally legitimate and customer focused, and there's one that comes to mind that's just a little bit sneaky. So the really customer oriented reasons are, you may have somebody who says, I want to be 50% international, I want to be 40% international, or I want to be 60% international. And somebody else who says, I'm happy tilting 50% to small in value, and somebody else who says, I want to tilt 30% to small in value. Well, now you have a whole bunch of knobs and dials, right? A client may say, well, I'm happy with everything but emerging markets. If you build one portfolio with 10 funds, you can address all of those needs with that same portfolio by going in and just setting up an Excel spreadsheet and entering some numbers. And every one of your clients can be invested in the same best 10 funds that you have chosen for them with fiduciary responsibility. And so your job as a manager is simpler, and your ability to manage a large number of funds is good, and to meet the needs of your clients. So I can see why people who manage money do it that way. It just, you have more control. There are compromises when you start to simplify down to one or two funds. And then the one kind of sneaky thing is that, it looks a little bit harder.
Hmm.
So it may be easier to charge for it because, hey, look at this, really elaborate thing I'm giving you, and don't you want to pay for that? It looks a little bit harder, but I'm going to say that, there's a lot of very legit advisors who are doing it not for sneaky and underhanded reasons. They're just doing it because it's a good way to address a wide range of needs precisely.
Yeah, that's great. And yeah, as Zach has said, we did talk a lot about the fee really playing such a huge part in all of investing and in all of retirement. And when we talk about retirement too, there's a new movement going on in the investing world, especially among like the younger 25 to 35 age, called FIRE.
Yeah.
So financial independence, retire early. And there are a few of our listeners that I'm sure are doing it or at least know about it. And they might be thinking right now, well, if I'm trying to do all of that, how would this two funds for life work? And would I set anything up differently? Would I still do everything just as it was said? Would I add more on my multiplier? How would that all look if they're looking at doing it that way?
Yeah, I love the fire movement. Like a lot of people, I like the financial independence focus a little bit more than the retire early, but I think most people I know in the fire movement are really more about financial independence, and then, do something cool, do something interesting
Yeah.
with their lives. It's not that they just want to kick their heels up. They want the latitude to do something different and not just have to be focused on working for money, which is kind of what I'm doing now. I get to do something different. It's a lot of fun. There is a chapter in the book about late starts, so that can help people out. It does some testing with a smaller runway, shorter number of years, and what happens if you have surprises. But I think the fact that the book is written around this idea of years to retirement, that's a good starting point for somebody who is aiming to retire early. They can look at those scenarios that way, and you could, if you really wanted to be clever, you could even, since I report in the book how things grow year to year over time, they might even be able to kind of look at that and start to figure out, well, if I have zero here instead of this nest egg, what would happen if I start late? And I'd love to have a calculator for them. just haven't built that yet. So got to get there one of these days. To that end, though, you can do a lot of the modeling I've done at Portfolio Visualizer using their financial goals Monte Carlo simulation. So if you have somebody who's kind of a fire-oriented person who really wants to figure this out on their own, you can go in there and put in your own glide path and run the numbers. And I think that would be the best solution I could think of right now for somebody in that situation.
That's awesome. That really helps too. Um, Honestly, as of now, I can't really think of any more questions. You really just handle all these really well. I appreciate that. Zach, do you have any other questions right now?
When can we have you back on to talk a little bit more in detail?
I'd be glad to come back. I'd love to. It'd be fun. So, we could schedule that. Your listeners will get tired of hearing me though. So,
I don't think so. I don't think
might
so.
be good to have a gap.
Yeah. Speaking of that, though, where can people find you that might be interested in learning more? Also, your book. Where are you at right now if people were interested in finding you?
The simplest thing, almost all of our work is at www.paulmerriman.com, and that's PAULMERRIMAN.com. And we do there. You can sign up there for the newsletter. I do question and answers in the newsletter, so a number of people email me and I respond. We do weekly podcasts called Sound Investing, where Paul's on every week, and occasionally Daryl and I hop on too. And the book is available free as a PDF there. The only reason people might want to buy it at Amazon is that there are a lot of charts in the book. And if you want to mark it up or see them printed on pages and be able to thumb it, just like stick your fingers in and go back and forth, sometimes that's easier. But you can also open the PDF in two windows and do that. So yeah, that's where we are.
Yeah, and I just really, before we let you go, I really want to prop up everything that you guys are doing at the Merriman Foundation. I've been following you for a number of years. I listen to Sound Investing every week, every podcast. I make sure I'm tuned in. I love the work that Paul's doing. The really honestly, in my mind, he was one of the first ones that really kind of helped me get onto the whole investing's not as complicated as I thought it was. And in my early 20s, newly married, not really sure what I was doing when it came to money. Listening to the podcast, he really broke it down in a way that was so simple and approachable. So for anybody who is really curious on investing, we're going to try to have people on like Chris and maybe even Paul someday, where we can have people who really explain it and are doing such great work to kind of get it to where finances, personal finance and investing and all these different things don't have to be as complicated as people are making them. And that's really the goal that we have here at Financial Feast Podcast. And I know that's the goal that you guys have at the Merriman Foundation, where we really trying to make these small little changes, right? And over time, we can see how they're really affecting our life holistically. And it doesn't have to be all at once. So I really want to thank you for all the work that you're doing, how it's affected me and my family personally. And hopefully it's going to make a difference in our listeners.
Well, I hope so too. And thank you, Zach and Kevin, for the opportunity. This has been fun, and I think Paul would very much like to talk to your audience. So I'd encourage you to reach out to him. I'll be happy to help make the connection there.
I appreciate it, Chris. Thanks again once more for coming on. And for everybody else, we'll be on next week for another episode. So stay tuned. Thank you for listening.